Hey folks, today's video I am going to talk about 5 different ways that you could possibly save on your payment on a mortgage since the interest rates are so high. And as of today, which is July 25th, 2023, we're sitting at about 7.04 with the mortgage rates. So these 5 different ways are going to give you some ideas and some chance to maybe lower your payment. So if you're one who wants to get into a house soon, but maybe you're waiting for the interest rates to come down, or if you're waiting for a crash to happen, maybe this could get you into a home a little sooner. I can't tell you that for sure. Only you can decide. So let's get into it. Okay, number 1, you could put more down on the house. The more you put down, especially if you can squeeze 20%, that 20%, that's going to get you a loan where you don't have mortgage insurance. Now, mortgage insurance, just in case you're not sure, that is when you pay a little bit extra upfront and also in the payment to help ensure that in case of a foreclosure, the bank is going to get the amount that they've loaned. So by putting 20% or more down, you don't have that. That saves you, it could save, depending on the price of the home, it could save you $50 a month, $100+ a month. So that's one way of saving. Plus, the more you put down, the less that you're going to get financed and the less your payment's going to be. Number 2, you could get a 15-year loan. Now, 15-year loan, the interest rate is usually about a quarter, maybe even 0.5% lower, maybe even more, than a 30-year loan. Now, if you're payment conscious, you're going to see that with a 15-year mortgage, you're paying it off quicker. So your payment is going to be a little bit higher, but the amount of interest that you'll save is going to be significantly higher than if you did a 30-year loan. But here's the thing though, if that doesn't work for you, you can still get the 30-year loan and make extra payments, and that can help you save thousands of dollars of interest throughout the remaining of your loan. Number 3, you can do a FHA loan, and if you qualify in your military, you can do a VA loan. Both of those types of loans, the interest rate is lower than a conventional loan, so that can save you money over the life of the loan and also help to lower your payment as well. Okay, number 4, an ARM, a 5-1 ARM, which means 5 years you'll have a certain interest rate, and then once a year after that it'll change, and it'll change based on the market at the time. Now, the benefit of that is it's a little bit lower than the current rates for conventional, but not a whole lot. So if it's a loan that you plan on moving within those 5 years, or you could even refinance before the 5 years is up and get a 30-year fixed, you can do that as well. Sometimes it is a big difference in interest rate and it makes sense. So really you should talk to a mortgage person, and I have plenty that I've worked with that I'd be happy to refer you to see if an ARM would work for you or not. Number 5, a buy down. A buy down is where you pay points, and that helps to buy down your interest rate, just like it sounds, buy down. So for example, let's say your mortgage is $400,000. 1% equals 1 point, which buys it down by a quarter. So if you put 1% towards your buy down, you get a quarter off your interest rate. If you do 2%, you get half off your interest rate. So the more you put down towards points, that percentage, that 1%, it knocks that interest rate down, which is going to save you on your payment, and it's also going to save you lots of money throughout your whole entire loan. Again, that's a good talk to have with a lender. See how you qualify, see if that would work for you. Sometimes we can do that in a way where we request that the seller pays that for you. So instead of them paying closing costs, that goes directly to your closing costs, maybe we can have them pay 3% towards your buy down or 4% towards your buy down. That would be a whole percentage coming off that interest rate, and that'll save you some money in the long run and also monthly too. So that's another option. So that's the 5 ways, 5 different options. Maybe you haven't heard of those, you didn't think of that. Another thing, and this is a bonus option, is let's say you do a conventional loan, but you do the conventional loan for less than 20% down. There's 3%, there's 5%, 10%. Those under 20%, remember, you're going to have mortgage insurance. So with a conventional loan, though, after you've hit 20% in a loan of equity, you can request to the lender to have that removed. That also, and it also means if our prices, our values go up too, and you get that 20% equity that way, or a combination of rates, you're paying it down, the value's going up, you can request the mortgage insurance to come off. You can't do that with FHA. Many moons ago, they allowed it, and they changed it years ago to where you can't request that to come off. The only way for FHA that it'll come off is if you actually refinance it. And that might not be a bad thing either. Maybe you could refinance it, put more down. You also will have closing costs whenever you refinance it too. So yeah, you need to think about that too, because if you're not going to be living in the house for a long period of time and you're going to sell or maybe even pay it off, it might not benefit you to refinance it. So those are the different ways. If you want to talk about it with me, check out that number on the screen. I really enjoy answering questions. I love doing that. I just enjoy educating people on the home buying process. So reach out. You can call me. You can text me. However you want to reach out. I'm here to answer your questions.